Good afternoon and thank you for joining the Future of Finance's webinar today on central bank digital currencies. I shall now pass you over to Dominic Hobson.
Good morning to our watchers and listeners in the Americas, and good afternoon to their peers in Europe, and good evening to a surprisingly large number of listeners in Asia. I'm Dominic Hobson, the co-founder of Future of Finance. It's my privilege to moderate this webinar. Now, our subject today is central bank digital currencies, or CBDCs. CBDCs appear to be an idea whose time has come. Benoit Cœuré, a former chief economist at the French Treasury and a former member of the executive board of the European Central Bank, who now runs the innovation hub at the Bank for International Settlements in Basel, as recently as November 2018 described Bitcoin as the evil spawn of the financial crisis, and quoted approvingly the general manager of the BIS for describing Bitcoin as a combination of a bubble, a Ponzi scheme, and an environmental disaster. Yet in January this year, I heard Benoit Cœuré say at Davos that he thinks CBDCs will come in due course. More recently, in a podcast just in the third week of last month, he reiterated that he is pretty sure that a CBDC will happen. Now, a Bitcoin and a CBDC are not, of course, the same thing, but I think it's not unfair to see them both, to borrow a verb from the great man, as being spawned by the same technology. So it's not surprising this webinar has generated a huge amount of interest, and I'm looking forward to our discussion to help us explore the pros and cons of CBDCs, the practicalities of issuing and using them, and the implications, not just for the payments and securities industries in the narrow sense, but actually for the economies, the monetary policies, and indeed the societies that we all live in. Now, from our sponsors at R3, we're joined by Daniel Eidan, who's a computer scientist now working as a solution architect at R3. He's co-author of a recent R3 white paper, which I urge everybody to read, called Central Bank Digital Currency and Innovation in Payments. Keith Baer, where are you, Keith? Give us a wave. Is a physicist and ex-IBMer, now enjoying a fellowship at the Judge Business School in Cambridge, where he's linked to the Centre for Alternative Finance. Simon Chantry, give us a wave, Simon, is a mechanical engineer who co-founded BIT, a payments industry fintech working on a CBDC with the Eastern Caribbean Central Bank. Their website, I might tell listeners, also happens to host a CBDC hub, which is a very useful repository of information about CBDCs. Rob Patalano, where are you, Rob? In the middle of my screen there. He's an economist who's worked at the Fed and the ECB and with the Financial Stability Board. Who's now leading financial markets activities at the OECD in Paris as a deputy head of division. Alex Powell is a physicist and electronic engineer, a former consultant with Accenture and EY. Also had a spell at HSBC. He's now Chief Technology Officer, UK and Ireland at Euroclear, which of course delivers securities against cash in central bank money in both those countries. David Schreier is a biologist, an entrepreneur, a teacher, an author, including, I might say, the author of the excellent Basic Blockchain. He's also a futurist with dual appointments at the University of Oxford and MIT. And he has, as we shall see, a special interest in the impact of digital technologies on social and economic problems. Last but not least, Sean Steinsmith is an assistant professor. Hello, Sean. Specializing in accounting, economics, and business at Raymond College, an independent college of the City University of New York, where he's done a lot of work examining the impact of blockchain and digital assets on accounting and financial reporting. Now, in addition to our panelists, we do, of course, have you, the audience, who's listening as well. But everybody watching or listening is free to submit a question at any time to all of our panelists. All you need to do is use the Q&A. We have used the chat. The Q&A is preferred. It's the functionality at the bottom of your Zoom screen, and you can direct your questions to all members of the panel or to a specific member of the panel, and you can do it on a fully disclosed basis or anonymously if you prefer. Now, unlike most webinars, we won't be saving up questions to the end, but we'll be addressing them as we go along. So please don't hesitate to get involved as soon as you can. As at any future finance event, we want everybody to be part of this discussion. This is a fascinating topic, and we have a very large panel, as well as a large audience. We would like as many people as possible to contribute. Now, I'd like to begin, I think, by considering the pros and cons of CBDCs, i.e. what opportunities do they create, what opportunities do they close down, what risks do they create or exacerbate, and what risks do they mitigate. And Daniel, I'd like to come to you first, because perhaps you could get us going with perhaps just a quick summary of what you said about in the early part of the white paper you've just written. The opportunities, I'm thinking here, it's a reliable substitute for cash. Our economies are digital, we need digital currencies. But of course, in the early discussions about CBDCs, the primary risk which was identified was that commercial banks would start to lose their funding base as deposits switched out of commercial bank money into central bank money. So what's your take on the opportunities and the risks of CBDCs?
Thanks, Dominic. I appreciate the question, and that's a great question to start with. And I'll try to not take up too much time, because I think we can talk about this question for the duration of the entire panel. So, maybe at the broadest level, I would say, there's obviously very clear and large opportunities that the issuance of CBDC can open up, and there's also a wide range of risks that can happen as well. And a lot of this is going to be focused on design and implementation, partially, and also who you ask and what your role is in the system today and what it can be in the future when CBDCs do present themselves. I think, maybe just to kind of set the stage, I think it's important to remember that, innovation in finance and in payment has been happening for a long time. So we're just on a continuous trajectory curve. This isn't something that is all of a sudden happening. I think the pace of that change is accelerating, which might make it feel like this is something that is somewhat out of the ordinary, but it isn't at all. And the signal of the times is very much that we can't close put our head in the sand and not look at what's going on in the global economy. I mean, top of mind is obviously the current pandemic and the unfortunate circumstances that we're in, but that's all serving as a catalyst, especially on the retail payment side, and we can see a huge increase in digital retail payments. But like I said, I mean, the things that are happening with the People's Bank of China, the things that are happening with cryptocurrencies more broadly, the things that are happening with stable coins and Libra in particular are all driving momentum towards central banks looking at central bank digital currencies in a clear and more clearly articulating what their value proposition is to the industry. I would say that at the forefront of the opportunities are probably four kind of distinct sectors. Payments versus payments. So just payments versus payments in a domestic context and in a cross-border context. And the second kind of quadrant that I would think about is security settlement, both in a domestic context and in a cross-border context as well. You can kind of subdivide those further into smaller and smaller categories, but those four quadrants would pretty much cover the entire sector of where CBDC would play a functional role in today's economy. The risks are also large, because the flip side of innovation is introduction to risk and some uncertainty. So I think we need to do, our task is to do a job of kind of managing the risks and rewards that this presents. But I'll pass it back to you, Dominic, and pass it back to anybody in the panel that wants to extend on those.
Daniel, Keith, perhaps I could come to you. You've heard Daniel say that P2P payments and on-chain settlement in the securities industry are two of the clear opportunities here. The risks. What about some of the macro risks here? I mentioned a few minutes ago the destabilization of bank funding, but do you think central banks are showing such a high level of interest in central bank currencies because they've been a bit spooked by Libra, by the strong performance of Bitcoin since the crisis began? They feel they might actually start to lose control of monetary policy.
Well, I think that's certainly a consideration. I mean, less so Bitcoin, I think, because obviously the central banks, BIS, et cetera, have published quite a lot that the Bitcoin ecosystem is a tiny fraction of the, the world's money supply in that respect. But obviously Libra, with the potential it might have had with the, over 1 billion potential users of it from a Facebook perspective, could have had a much more significant impact. So obviously that was a significant catalyst for central banks to take action. And some of the surveys BIS have published, for instance, show how there's been a significant increase in ramping up of CBDC efforts by the central banks over the kind of 2017, 18, 19 timeframe, which is indicative of that. Just a comment to follow on from what Daniel was saying, I think the other key element, key question is what the objectives of individual central banks are. They have different objectives, and dependent on how they go about approaching CBDC will have an impact on the risks they face as well. So for example, Sweden, obviously one of the countries that has focused very early on, and a POC that they've done with R3 and the feedback on that they published. They've got not a unique, but particular characteristic with a relatively small amount of physical cash within their economy. And that obviously leads them to CBDC as a natural extension to address the kind of economic environment, which contrasts quite differently to China, obviously, with what the People's Bank are doing and the objectives that has in terms of one level being able to have better control over what happens from a payments perspective, but also facilitating some of the reduction maybe on dominance of the dollar, supporting One Belt, One Road, etc. There's a whole potential political agenda associated with what they may be wishing to achieve, which contrasts again to the Bahamas and Sand Dollar, which Simon may want to comment on, which, as I understand it, is much more focused on being able to provide payments for outlying islands within the Bahamas and being able to facilitate things more from an inclusion kind of basis. So I think there's a key question in terms of what the objectives of the central banks are, what kind of approach they may end up taking as a result of what those objectives are, and what the implications of that approach may be. So for example, arguably most of the CBDC projects, like Sweden, for instance, and I think China as well, are taking this two-tier approach with the central bank providing CBDC to a second tier of basically commercial banks, who then distribute CBDC to third-party consumers, etc., at the lowest part of the tier. So that kind of approach, depending on how it's constructed, can alleviate some of the risks in terms of the roles that the central bank, the commercial banks have, making sure that they're not disintermediated in the way they would be if it was CBDC directly issued to the general public from the central bank itself. So I think the answers we'll see will be different according to each central bank, and what central banks will do individually will depend on what kind of problem or what kind of opportunity they're trying to solve for in that respect.
Yeah, we certainly see central banks responding culturally, if you like. The Bank of England is going down a retail path, and the Bank of France is going down a wholesale path. Chinese, as you say, have geopolitical ambitions of this as well.
Indeed.
We're going to suddenly get questions in, and I'll turn to those in just a second, but I'd like to give all of our panelists at least a chance to say something before we turn to questions. David, could I come to you? Because I know that you've been working with the Commonwealth on a fintech toolkit. So how can a CBDC help the developing economies of the Commonwealth grow faster and become richer and more prosperous?
Yeah, so picking up on Keith's point about kind of the rationales for central banks choosing to issue central bank digital currency varying by the needs of the country and the policy objectives, Bahamas in particular, one of the major drivers, frankly, was the devastating effects of hurricanes in the Caribbean. And so because people had limited trust in banks and kept a lot of cash money literally stuffed under their mattresses, when I think it was Hurricane Dorian blew through, literally all their money blew away in the wind. And so the central bank is stepping up.
The government to blow money away.
So you have a lot of individual consumer impact, which is devastating. Beyond losing your home, you also have lost your life savings. And so the government is leapfrogging with a central bank digital currency project, as I understand it, around the issue of providing for a resilient personal savings capacity, a store of value that does not blow away when your house does. So that's a really sort of interesting motivator in that instance. More broadly across the Commonwealth, we do see a variety of governments that were interested in central bank digital currencies, and seeing that interest intensifying with the launch of of kind of the RMB coin and Libra, and people starting to take it seriously, not the least of which led by Mark Carney's call for a federated digital currency that's not beholden to either US dollar or China yuan hegemony. So it's an intriguing concept. With the toolkit that we're creating, we're trying to address that need that, you know, across the 46 or so central banks that serve the 53 Commonwealth countries, you have a variety of capacities of understanding amongst central bankers. So they need to know, well, what is distributed ledger? How can I apply it in creating a central bank digital currency? And who are the ecosystem participants that I can engage, and how can I engage them? And so the toolkit is intended to provide a roadmap as we see burgeoning interest across numerous countries in implementing CBDCs.
Thank you, David. Simon, perhaps you could give us a quick oversight. You're also involved in a CBDC directly in the Caribbean. Could you tell us what the pros and cons of the people you're working with see in a CBDC?
Sure, absolutely. Thanks, Dominic. So for those of you who don't know, I'm part of bit.com, and yes, we're working with the Eastern Caribbean Central Bank. Governor Timothy Antoine was ahead of his time. He gave the go-ahead for this project in March of 2019 after extensive specification building over the course of the previous year. So the motivations in the Eastern Caribbean Currency Union, and for those of you who don't know, it is a monetary union, one of the oldest monetary unions of 8 countries, collective population of about 750,000 roughly. Their major goal is to decrease cash usage, decrease check usage. There's a lot of dated payment instruments throughout the Eastern Caribbean Currency Union. But in addition, financial inclusion is also a big issue. Financial inclusion is a big issue throughout the Caribbean. The cost of maintaining accounts with the legacy financial institutions is prohibitive. And with that sort of barrier to entry to just having some sort of modern digitized financial services, that's where Governor Antoine and the Eastern Caribbean Central Bank chose to act, was to implement sort of low cost, accessible digital payment services, digital financial services. And so it really does cover the gamut. You know, we have, we've built sort of what I consider to be a vertically integrated digital currency software stack. So we are basically tailoring a version of Hyperledger Fabric for the Eastern Caribbean Central Bank. And then we've built sort of the overlying applications that are required for each stakeholder to interact with that. So at the central bank level, they have a central bank portal where they can mint, issue, distribute, redeem, destroy digital currency units. They can monitor the effects of monetary policy, adjust the interest rate, and so on. Similarly, commercial banks have their own portal, merchants have their own portal. And then of course, at the retail and enterprise level, we have mobile wallets and merchant applications and e-commerce plugin, so that everybody in the transacting economy can basically take part in spending digital Eastern Caribbean dollars. The network's called the DXCD Carib network. But yeah, coming back to the motivations, I would definitely say when you think about 8 countries that are all using the same currency and yet don't have the ability necessary right now to transfer same day peer-to-peer, of course we want to be able to provide that capability. So cross-border payments in the same currency. Similarly, we're working towards an objective of the Caribbean Settlement Network. So we actually have digital Barbados dollars in circulation right now as well, with a healthy and growing ecosystem in Barbados. So that's sort of our next step after is to start going cross-currency using atomic swap functionality across chains. But certainly I would say if I were to summarize, Dominic, it's financial inclusion, bringing people more powerful digital financial services, and sort of using that as a stepping stone to build the economy and transaction volume throughout the OECS and the ECCU.
Thank you, Simon. Now, Sean, you've heard David and Simon speak very eloquently about the benefits in terms of financial inclusion, in terms of building a cross-border payments infrastructure, if you like, which can help increase the volume of transactions, volume of business which is being done.
Sure.
But if a central bank issues a central bank currency, that implies a massive inflation of its balance sheet, for one thing. Could you give us a flavor of what you see as the kind of macro risks of going down this path? What are they?
Oh yeah, well, so probably from a accounting and more of a economic markets point of view, I would say that a big risk at a sort of high level point of view is the possibility, one, of these banks' balance sheets expanding even more than they currently are, right? Because they all are expanding by hundreds of billions and probably trillions of dollars here in the US, in China, internationally also. But there's also a risk that I have not seen too much talked about because it's more of a nuanced issue. It's more of a emerging market issue. But as this new type of currency is being introduced in a nation or at a group of countries, right, there's always the risk that the actual market valuation of the current fiat and the new crypto fiat hybrid aren't going to be on a one-to-one basis. I know that Tether, right, is old hat now, right? But I mean, I do think that is a prime example of what happens if there's a misunderstanding as a new asset-backed coin, be it backed by a government, be it backed by gold, dollars, all the rest. If it's not understood exactly what is backing this new crypto fiat hybrid, and so it's an important note, I think, to fully acknowledge and to understand that any of these new crypto assets being introduced now are basically a half and halfway point, right? Because there is no country, be it the Marshall Islands, be it any country, any sort of group of countries that's trying to launch their own CBDC. No one country is actually ready to do this overnight or in the next half year or so, right? And so as these products are launched, there is always that risk that there is going to be obviously some inflationary pressures, as there's basically two forms of currency being introduced. And I believe it was in 2019, don't quote me on that, but I do believe that the impact over in India, I believe, right, when overnight there was a cancellation of certain types of currency notes, all of that caused chaos in the marketplace for months afterwards. So I do think it is worth sort of taking a note of caution as these projects are underway, and obviously there are a tremendous amount of upsides, right? Access to markets, access across the board to actually participate in the wealth saving and the wealth accumulation process. But there is also a risk, one, that there is going to be some sort of bifurcation in how these things are valued, and all of that could be amplified if certain aspects or certain areas of the country or of the population aren't able to access it on a ongoing basis.
Sean, Rob, you've heard Sean stay there that one of the issues central banks have in mind here is that stable coins, how are they going to work alongside fiat currency? There's a risk of losing control of monetary conditions. You spent time with central banks. Clearly their position has moved. Correct me if I'm wrong about that. But what do you think is uppermost in their minds in terms of the risks which they need to mitigate for a CBDC? What are they most concerned about?
Sure. Thank you, Dominic. And let me say it's a pleasure to be here to talk with these members about such important issues. I would like first to respond to Sean's point. I would agree that there is certainly a risk of central bank balance sheets becoming even larger, but I think it's fundamentally different. Right now, the reason why central bank balance sheets have grown very large is because they're stepping into a liquidity and credit intermediation function. They're buying sovereign and corporate debt, and that is for monetary policy purposes. I think in this case, if I understand the example correctly, is if you find that a central bank digital currency is pulling funding away from banks, while I don't think it is the purpose of the central bank under normal circumstances, of course the central banks could re-intermediate that money directly back to the banks. And in fact, we have a very good example of this in sort of a non-tech example. During the crisis, if you look at the ECB, with its framework, you had funding coming out of some stressed countries, so Ireland, for instance. As deposits were flowing out of the Irish banks, the central bank just turned around and got the cash from where their deposits were going and put it back into the bank. The challenge is, unlike deposits, such central bank maneuvers need collateral. And it could be the case as you're disintermediating deposits and you're re-intermediating that funding that needs to be collateralized, you could find that some banks actually find themselves short of funding. So that's a challenge. In terms of the risks, you know, I think that Libra really was a wake-up call for central banks. Not that they were afraid that Libra would necessarily step into monetary policy transmission or cause massive financial stability risk, although that's being assessed. But I think what it did was, it was a wake-up call to force them to accelerate their concepts and to really start moving forward, including with some of the members on this panel, to really think about design and implementation. So it's very important to see now that we're having real discussions about how different designs can have both different effects on the financial system and different designs serve different purposes. So I think that discussion is a really positive one. And let me just end with this. With the development of these technologies, central banks are in the position to manage these operational risks and financial risks. And yes, there are risks. We've raised a number of risks, but the issue now is for central banks to appropriately to assess those risks and to determine design and risk mitigation features to make sure this works effectively. And that's why they're trying to take the time and do these pilots and have consultations, et cetera. So I think we're on the right path.
Thank you, Rob. Alex, I'm conscious you haven't had a chance to say anything yet. Perhaps you could give us some observations on that last point, which Rob raised there about operational risk here. At the moment, we're in a system with fiat currencies where the central banks run the real-time gross settlement systems. So the ultimate infrastructure in both securities and cash settlement is the central bank. If these currencies are allowed to, or enabled to, or grow without supervision, you could start to see rival infrastructures emerge. But what's your take on the impact of CBDCs on the way in which you settle securities against cash, or indeed as cash is settled against cash in the payments industry? Is the CBDC going to be good for an organization which settles transactions in central bank money, or is it going to be unhelpful? What's your feeling about it?
So thank you very much, Dominic. That's a very interesting question, and there's quite a number of facets to what you've asked for there. I mean, clearly, you know, as an organisation in the UK alone, we're settling 640 billion of central bank money per day. We're doing that atomically. The term that we use is simultaneous and irrevocable transfer of central bank funds, whilst at the same time irrevocable transfer of securities. And you know, that effectively is what we're operating today. Now, clearly, if you look at what the central banks have got to do, they will provide with CBDC, I imagine, very most likely not an unlimited amount of CBDC, but a contained amount that will be topped up or drawn down within certain parameters to allow the central banks to operate monetary controls on it, which are very, very important. And I think, you know, if you look at it from the point of view perhaps of the payments world, it could be a real game changer if, for example, some of the PVP cross-border started to get going, because that is an area where today, you know, there are organizations who remove the what's called the Herstat risk, you know, the risk of timing differences between settlement of different currencies. And you know, if central banks are able to do that with a CBDC, or in fact with another mechanism, but it doesn't actually have to be CBDC, so that they can integrate the timing and match the timings and to reduce the Herstat risk, and that issue goes away. But clearly, you know, when a central bank issues a certain, you know, has a certain reserves, a proportion of those reserves would be allocated for CBDC, and the central banks would need to have. They want to know, you know, who holds the reserves, who are the account holders in each reserve, how much does HSBC have, how much do the big banks have, how much is out there for CBDC. So it's a very interesting conundrum, and I think what it potentially does is change the relationship, or could change the relationship with the commercial banks. And clearly the commercial banks have a role to play, and I think the commercial banks obviously extend credit, and they often perform a lot of the the KYC and AML checks, which the central banks may not want to do. So, the actual models, and there are a number of models being proposed. Some of them are called synthetic, some of them are called hybrid. There's a whole range, and some are in the very good R3 paper that's in here. However, there are lots of challenges. Perhaps I'll just, if I may, just make a few comments about security settlement. So, from a certainly from a market infrastructure point of view, clearly one form of CBDC is what we deal with today. Where the central bank is going to issue another form of CBDC, we would welcome that as another way of settling in central bank money. So I think really where the opportunities might arise might be between the interfacing for the exchange of cash and securities in how should I call it, the retail world more, and perhaps as an interface between that wholesale world and the retail world. But there's clearly work to come on that, and there's developments to be made.
Thank you, Alex. I'd like to turn to some of the questions we've had now. Peter Smith asks, and this is relevant to something which Alex said. Peter Smith asks, although the primary leaders of these initiatives will be central banks, can we anticipate extensive private-public sector partnerships, where, for example, the private sector provides or indeed runs the technology, the infrastructure, the operations, and the customer services on an outsourced or more deeply collaborative basis? And I say it's relevant to what Alex said, because one of the things Alex brought up was Herstat risk, where the central banks waited for many years for the private banks to actually solve Herstat risk. But when they failed to do it, they had to step in themselves and set up CLS, which has taken away that risk. So we have some experience of waiting for the private sector to solve problems, and it's not encouraging in the area of cross-border cash settlement, at least. Daniel, do you, R3 is probably as best placed as any organization on the panel to tell us how far, well, where the division of labor will be, if you like, between the private sector and the public. What would you anticipate?
That's a great question, and I don't think anybody has the answer quite yet, but I think that's definitely something that we're working towards understanding. I guess the general trajectory is that the public institutions can act as operators, catalysts, and overseers for CBDC type implementations, and to find that line where the public sector stops and they enable the private sector to build on top of that foundation. So, along with that, you look at the role of the public sector as an operator, an overseer, and a catalyst of payments. Also, de-risking the process as well, looking at systemic risk, looking at fraud, looking at counterfeiting, potentially also looking at AML, and then drawing the line in the sand where the private sector can come in and build kind of last mile solutions, have open competition between them, and really do what they do best, which is innovate and interface with the end user. So I don't have the answer, but that's very much kind of the trajectory that we're on, and I think it's going to be different in every kind of economic zone and in every country. It's going to take a slightly different form.
Anyone else have views, Simon? Do you have a view on private-public sector? You're obviously engaged in one, so you think there must be something here which works.
Yeah, I'm one data point that says we're heading in that direction. But we are seeing central banks increase their own technology teams in-house because they want to understand these solutions much better. I guess what I wanted to point out was that I think an important element, at least in the context of payments, is that these networks will serve as sort of digital public infrastructure, where the central bank will either subsidize or operate, as Daniel mentioned, and the ongoing provision of an underlying digital currency network that approved participants, so payment service providers and commercial banks, will be able to integrate into. So the Bank of England calls it the platform model. The Bank for International Settlements calls it a marketplace model. We've always referred to it as a marketplace model as well. But the notion there is that the central bank perhaps in partnership, especially, you know, in our example, it's in partnership with a private technology services provider, operates this digital currency network, and then enables, you know, licensed payment service providers and commercial banks and financial institutions to interact with that ledger to provide payment services and other central bank digital currencies services to the general public.
David, I noticed you were nodding furiously there. Did you have something to add on this question about public-private sector collaboration?
Yeah, well, a couple of things. One is around the capacity building within central banks, right? So they very much have become aware that they can't simply sit back and let the technology evolve around them, that they need to build internal capabilities. And that's a lot of the work that we've been fostering with the Commonwealth. But the other part of the discussion I thought we haven't really gotten into yet is the link between CBDCs and government revenue. So some of the interest that I've been hearing has been from tax authorities. And so, for example, it solves a number of interesting problems. So for example, in sub-Saharan Africa, there is a major sort of tax gap on tax avoidance and tax compliance rates versus other, versus OECD countries. And when the research is conducted to look as to why, it's not because people don't want to pay taxes. They want the benefits of roads and medicine and education and the other benefits of government. Their concern is around corruption and diversion. When they pay their taxes, is there transparency around how the money is spent? And so there's a potential that a better monetary system built around CBDCs could provide for greater transparency around tax. So it's an interesting fork in the road, but one that a number of folks, including the World Bank, are diving into.
And you think that's an area where the private sector can play a part in achieving tax transparency?
Absolutely, because it'll lower costs of tax compliance for the private sector. So MIT, Ernst & Young, and the World Bank have a cooperative called the Prosperity Collaborative. And EY is involved because they see a lot of benefits for their clients around lower cost and more rapid engagement around tax discussion. So instead of spending many tens of millions on engaging with a tax audit, you can do it automatically in 5 minutes over a distributed ledger.
Okay, well, that sounds like empowering governments a bit more than some people might enjoy, but we'll come back to that in the final part of our discussion. I've got a second question here from Gavin Brown up at the University in Liverpool, who looks at these things. It's not an easy question, but I'm interested to know what panelists think. It's what potential do you think a synthetic hegemonic currency, brackets, SHC brackets, might play as a CBDC representing multiple monetary jurisdictions, especially given the collaboration of BIS and multiple central banks in this space, please? Rob, is this something which is being discussed?
Yes, sure, I'd be happy to take a stab. That's an excellent question. It's a complex question. I do think that at this point in time, that there is a comfort zone right now with both central banks and regulators working within their domestic sphere and working with either central bank digital currencies or entertaining the idea of very well supervised fiat-backed one-to-one private currencies. And I would find it hard-pressed, this is my personal view, but I would find it hard-pressed for another global big tech or another player to come out and launch a global currency of that nature. Now, if you're thinking about sort of the Carney vision of some sort of hegemonic currency that could challenge the dollar in cash or digital form, I think that's worthy of a discussion about who would do that, whether it's an international organization like the BIS or the IMF, whether they would want to play that role, whether there are benefits of that role. But I think that's probably a medium-term discussion, and the pilots at a country level, seeing certain large countries or even small countries issue CBDC and the consequences of those issuance, I would think that both the central banks and the regulators would try and manage it at that level first and have international discussions to try and understand how it's working out and looking at intended and unintended consequences before there's another discussion or serious consideration of any sort of global currency in that regard.
I think you're right about this. Daniel, you wanted to say something? Go ahead.
Yeah, sure. I'd love to add to that, Rob. I think that was a great answer. I think that maybe this is a good point to raise. interoperability between different platforms and different service providers. So maybe instead of seeing a synthetic hegemonic currency that spans multiple jurisdictions, I think what's more likely to happen is that we're going to see this kind of buildup of domestic capacity, and while we do so, we're going to ensure that every domestic public kind of context can interoperate with different systems. Sometimes this is at the platform level, at the technology level, and sometimes this is more at a governance and compliance level as well. But I think that when I look at interoperability, especially on the technical side, at the platform level, what's driving it is very much CBDC and central bank use cases.
I mean, just to add to that briefly, maybe, I mean, it's interesting, I think, to see that some of the central bank efforts like Ubin from Singapore and some of the others that are taking place are experimenting, and the POCs are taking place on multiple technology platforms, be they Corda, Hyperledger Fabric, etc. And it's interesting, I think we have examples on the panel, obviously, from both the using Fabric for that and using Corda for that. So I think the central banks recognize that those challenges as well, and it's good to see that multiple technologies are being used, and which I think fosters and causes collaboration around the interoperability challenge there as well.
Rob, you wanted to add something.
Yes, I just had a two-hander, just advice to the audience to say, if you want to get a flavor of the sense of central banks, finance ministers, and regulators about global stablecoins of any form, I would suggest looking at the Financial Stability Board's work and its recent consultation, because you will get a sense of the heightened sensitivity over how to regulate and how to share data with respect to cross-border digital flows. That's a big challenge.
Which is, of course, a neat segue into something I'd like to perhaps spend our remaining time in this discussion on, which is the wider implications of CBDCs. Listening to you, Rob, and listening to what Keith said afterwards and what Daniel said, I began to think, well, we might not have more than just multiple technology platforms here. We might actually end up with multiple currencies, some private, some public, some asset-backed, some utility coins, some stable coins. We might end up with a kind of monetary, if we're looking very far ahead, with a sort of monetary chaos, if you like, in which we choose currencies which express values which we hold dear. We might have Manchester United coins, for example, as well as Greenpeace coins or whatever. Rob, just perhaps very quickly from you, is this a concern on the part of central banks that actually you get a kind of not just monetary Esperantos like SHC, but you get a kind of monetary chaos in which the link between monetary policy and the value of money and the stability of the financial systems and economies is really hard for them to control. And that, in a way, is a CBDC an attempt by the central banks to grab back control?
Yeah, I think that there's a lot of analytical work that needs to be done. A lot of very good work is being done now in central bank digital currencies. I think we need to take a step back, which is why I think this session is so helpful, to take a step back and say, what could the system look like out 5 to 10 years? And presumably it's going to have a mix of all of these things, and the mix will be different depending on the nature of the financial system and the desires of both authorities, such as the central bank, and the desires of society, depending on where they are on the spectrum of heading to sort of cashless interactions. And I would imagine that even with the central bank digital currency, you would have forms of private quasi-currencies. Probably in the near term, it would be more like a fiat-backed one-to-one. But I think the next question that we should all be debating over the next several years or sooner is, how do these different coins, legitimate central bank coins, and also private sector crypto assets that have coin-like qualities, how do they interact? And the question for policymakers should be to assess it and to understand, how do you extract the benefits and manage the risks? This is what policymakers do, and I think it's incumbent upon all of us, including the private sector, such a valuable role to play to help educate public sector players about medium-term issues and consequences.
Sean, perhaps I could bring you in at this point. Do you see CBDCs as a catch-up by central banks trying to get on top of monetary developments which they feel are spinning out of their control, or is it something different?
No, and I would say so. Yes, building on the other excellent comments, but I would say yes, right? That really this whole uptick in interest and enthusiasm, and this really sort of upsurge in expertise, teams, and interest in everything blockchain linked, right? Be it crypto assets, be it fiat-backed coins, basically the openness to be even having these talks and conversations. If you had had this panel 18 months ago, I doubt anybody here on the panel or tuning in would have said that either China or the U.S. would even be having pilot projects, conversations on trying to link their fiat, basically sort of their tool for tax enforcement, revenues, and trying to enforce policies both internally and externally on a sort of international basis. Even having those linked to a blockchain or to a crypto project, I don't think that actually would have happened. But also to just add in a extra point here, all of us are having this fantastic conversation around crypto assets issued by governments, cross-border, interoperating, and all of that's great stuff. But I do think that the taxation treatment of these various crypto assets, right? Because I personally think there are going to be hundreds, if not thousands, of options out there. In the markets, there are ETFs that can appeal to everybody. ESG, Vice, oil, nat gas. There are hundreds and thousands of ETFs catering to individual audiences based on their preference, on their interest. And so I don't see why this area will evolve any differently. But a major headwind, right, to anybody actually taking these tools and then using them on an individual basis, right, on a merchant-to-merchant basis, outside of the operational stuff, privacy stuff, interoperating, is how are they going to be treated, right, from a tax point of view, from a accounting point of view. So if I'm an individual and I'm trying to use this crypto fiat-backed dollar, do I have to pay taxes on every single purchase? And I do think having a conversation on a country-by-country basis, but also on a international basis, is important to have that resolved, because there have been updates out of the SEC, FSB, all of the alphabet soup agencies on this topic, but there is no consistent framework. And even in certain countries, depending on the oversight body that is consulted, these oversight agencies and bodies have different points of view. So I do think that this bigger conversation on these crypto assets being issued now on behest of the government itself, I think a big benefit of that, outside of sort of getting a handle on the issue, is to help push that policy conversation off the back burner and onto the front burner, and in turn, having these conversations be more consistent is going to help folks actually take these assets out of the banking system and out into the marketplace to actually make them a one-to-one alternative to the current options out there.
Now, some of the central banks coming to that conversation will have a, if you like, a more liberal outlook than others. Do we face here, in country by country, a choice between a CBDC which absolutely monopolizes money in a country versus other countries where a CBDC may be just the underpinning of a variety of private currencies, or maybe it's just one currency among many which people use? I don't know whether I assume the choice is not really ultimately an either or of that kind, but it does bring into focus the issues for economic, personal liberty. You know, if we ended up in a situation where a central bank was the only currency, everybody had an account at the central bank, everybody was paid their taxes at the central bank, everybody received their benefits at the central bank could see everybody's transactions and what was going on, that has huge implications for economic and personal liberty, and indeed personal privacy as well. How well thought through are those sort of questions as we talk about CBDCs? David, I'm looking at you. Thinking, or is it? I've asked you so many
I was
questions.
just making some notes on that. So first and foremost, there's a little bit of a myth in the cryptocurrency world that thinks that Bitcoin is anonymous, even today. It's not anonymous. All of the enforcement professionals I know at major governments are delighted when criminals use Bitcoin because they say, now we can trace everything. Cash is anonymous. Physical paper money is anonymous. It's the last anonymous currency. So there are troubling privacy implications if, let's say, an authoritarian government got access to the books and ledgers of your central bank digital currency and its retail instantiations. There are ways to embed better protections for personal privacy into the code. I know Simon's done some of that work in that area, and he may have some thoughts to share, and others perhaps as well would care to chime in. But it becomes a real question of technology ethics that we all need to consider when we're implementing these systems. How can we ensure the benefits of technology with lower cost and more access while avoiding the troubling potential abuses of it? And Simon, perhaps you can also jump in at this point.
Yeah, thanks, David. So I've seen some good papers come out on design elements of central bank digital currencies. The IMF did a great one. I believe that was late last year. And I think the BIS just put out another one as well. So we're seeing sort of quite involved design considerations being discussed and thrown around. But privacy is one where it's a tough one because we have we've made quite a bit of progress since sort of the early 2000s around AML compliance and CFT. And yet, as David mentioned, if we're talking about a truly digital central bank money, cash is truly anonymous. It's a bearer instrument that's anonymous, and the only two people who are aware of any given transaction are the counterparties to that transaction. So, if it becomes a decision of how many elements of cash do we want to preserve in digitizing these central bank digital currencies. There are some really interesting technological solutions for preserving privacy while still being able to fulfill a lot of these AML compliance requirements, and certainly that's what we've been striving to do with our solution and the solution that will be deployed with the Eastern Caribbean Central Bank. We had been speaking yesterday about the possibility of building a system or having a nation build a system and then a tyrant becomes in control, and the damages that could cause to the entire nation and for quality of life and the economy, et cetera. So the idea, at least on the technologist side of things, is to try and future-proof and dive as deep as we can into the privacy and security considerations with the full understanding that we need to be able to preserve people's privacy and keep this as a tool for sovereignty. So it's, I'm thankful to see that the literature is quite progressed, that these design considerations are being taken very seriously. And I'm also enthusiastic about the technological progress that we've seen. Let's keep in mind that the reason we're talking about this is because blockchain and distributed ledger technology has sort of birthed this new asset class of crypto assets that are resilient enough to be around and worth hundreds of billions of dollars in aggregate today. And that has sort of forced the hand, in combination, of course, with Facebook's Libra and China pushing DCEP. That has, again, been a forcing function for central banks to experiment. And so it's that technological progress that sort of made it possible to have an international secure digital currency. And I think that's what central banks are dealing with now. What elements of that movement can they take and apply to digitizing their own currency for the benefit of themselves as institutions who regulate monetary supply and are meant to be bodies for economic stability, if not growth, but then also for their economies as well, and everybody who uses them.
Thank you, Simon. I'd like to address a few more questions that have come in now. This, I think, is one to which we know the answer, which is, how do you foresee the steady state or normal state where both CBDC and commercial bank deposits live together? And possibly if there's some form of shock or crisis which sees a significant movement of deposits into CBDC, could this exacerbate the crisis compared to today's system? And secondly, what tools or means could the central bank have to prevent such a crisis. Now, this was the argument against CBDCs a couple of years ago, was that actually just wipe out the basic form of funding for the commercial and private banking industry. Now the central banks are moving towards CBDCs. What has that question gone away, or what? What is the answer to that dilemma, Rob?
Sure. So I would say it's an excellent question when we're debating internally, because the relative value of a CBDC versus a central bank funding, a commercial bank deposit, that relative value depends in part on counterparty risk and preference. So if you're able to put your money with the central bank versus the commercial bank, depends on what rate you're getting, and also the functionality which you can do with the money at the central bank for payments, etc. If you turn this into the digital form, you have a central bank digital currency, the central bank may be able to bid that up during normal periods to still get that money away from the central bank in digital or even cash form. But then I think during crisis, the ease at which that money can flow back to the central bank, and perhaps the desirability to quickly have your money where there's no counterparty risk and there's trust in digital form, is very different than putting it under your mattress 100 years ago. So I think it's not just the unit of account and the store of value, but the desire for a digital medium of exchange, I think, is going to change the nature of this, and whether you quickly bring your money out of the commercial bank and back to the central bank. And that has a question that we're still working through, which is central banks have the tools, but that those tools could mean that the way that the central bank raises or lowers rates on digital currency, because it has a different demand function relative to cash, I think is a really complex one we have to think through. That I think is going to pose a challenge for central banks.
I think that also, just to add to what Robert mentioned, that's also reflective of the the decisions that the central banks need to make on how they want to implement a central bank digital currency. Obviously, the toolkits and what BIS are publishing are giving some greater informing, especially to the smaller central banks that may not have the capacity to do this research and design work themselves. But I'm mindful of the Bank of England's process at the moment with this very large collaborative discussion going on, seeking a lot of input from multiple stakeholders in terms of how the UK should implement a CBDC, and solving for those kinds of problems based on what the problem is they're trying to resolve, and the best design decisions to take, both from a business and a technology point of view, to be able to implement that.
Here's a question which has some bearing on the exorbitant privilege of being the world's premier reserve currency and the ambition, say, of China to supplant the US dollar. We've been asked this question. China, along with Japan, South Korea and Hong Kong, are developing a regional stable currency for facilitating trade payments. Do you expect such regional stable currencies to be developed in the future? And I assume one reason we're being asked that is because that trade at present is denominated in dollars. And if you could change that, you change the power dynamics as well.
Yeah, just to chip in there, if I may. I mean, that's the interesting parallel to that discussion, I think, are the blockchain-based trading networks that are evolving. So, for example, in Hong Kong, there's E-Trade Connect and others from HKMA. So trade and supply chains are getting implemented on blockchain to be able to reduce fraud, et cetera, et cetera. But in order to bring the payments onto those environments, it requires some kind of stable coin environment to facilitate trade as well. So the trade side is been going for 2-3 years. It has many successful networks such as Marco Polo and Contour and WeTrade and E-Trade Connect, etc. And now it's time to consider how to be able to do the payment legs associated with those transactions. And that, I think, is feeding into this. And as the central banks are being able to develop their CBDC strategies, these two forces are coming together. Example of that maybe in Thailand, for example, where the Bank of Thailand, as I think was mentioned already, looking at it from a wholesale point of view, but how they can facilitate payments around some of the large enterprises that exist within the Thai economy as a case in point.
With these, we're not talking here of an SHC, we're talking here of something much more modest in scope, just to...
Yeah, I mean, if you take a look at Professors Alex Lipton and Alex Pentland, they published a paper a few years ago now on TradeCoin, which proposes an architecture for what could be a regionally federated digital payments, digital currency. that would, essentially, instead of using dollar or even RMB as the backbone, you would use a basket of the goods that are being traded back and forth between the countries. So it's worth looking up.
In the same vein, the question here is, China's strategic push on their CBDC is arguably forcing the rest of the world to respond. To what extent is the US paralyzed in their response, owing to the tension between state and commerce as to who should lead this response effort and therefore have the rights to seniorage? CBDCs versus non-sovereign corporate currencies. Obviously, China doesn't face this same tension between the state and commerce owing to their political structure. So there you are. So China is a more monolithic political entity, and so they don't have to have debates within their government. The point I referred to earlier about not everyone comes to this with the same liberal outlook that people like us have, I suppose. Is this, I don't know whether there's anything to add to it, more like a comment than a question. I'm seeing more nods than, unless somebody wants to come in on that. I think we agree with that, right? Question here, do you think a CBDC can have an impact on contributions of banks to deposit insurance schemes? Not sure I understand that question. Does anybody understand that one? I'm not sure what we're getting at there. Put your hand up if you've got a thought on that. I guess it's a reference to the flight of deposits, really.
Yeah, that's what I think.
Yeah. Okay. So, yes, I think the answer to that is deposit insurance schemes will collapse along with the deposits.
There's a quick one there, if you don't mind, Dominic. Deposit insurance covers up to a certain amount, right? Depending on which country you're in. Whereas if you were to hold CBDC as a business, that is legal tender. And provided you are safeguarding your CBDC, it's technically secured by the central bank by way of security protocol. And so the value of the underlying currency should be maintained as long as the central bank itself is solvent, you see. Whereas the deposit insurance scheme is more of a function of private institutions and commercial banks to say we can guarantee you up to a certain point. Just a comment.
Well, no, in a world in which...
If I could just make a comment on that one as well, if I may. It's Alex here. Just from what Rob was saying, I think that's that's absolutely true. I guess the question is, what type of CBDC are we talking about? If it's true CBDC, where you as an individual have an account at the central bank, then yes, completely agree with you. If it's synthetic CBDC, where you effectively got a commercial entity that's standing between you and these who maybe hold collateral at the central bank, that's when you need the deposit insurance.
If fractional reserve banking survives the introduction of the CBDC, the problem with deposit insurance does not go away. Okay, thank you for that question. So it turned out to be a very helpful, clarifying one. Okay, this is a political question, really. DLT as a technology was looked at as a means to offer financial independence from banks, democratizing money. Please share your views on this from the CBDC perspective, financial independence versus excessive control. We sort of touched on this and danced around it a bit. Sean, I can see you're itching to address this liberty versus tyranny question on a CBDC. Is a CBDC compatible with a free society? I put the question as plainly as that.
Well, I mean, I would say that honestly, the whole sort of blockchain space has moved, right? Since 2012, 2013, up until now in 2020, it honestly has moved, right? From being open source, no rules, no barriers to entry, all of that, to honestly these types of topics right now, right? Trying to sort of not co-opt really, but almost sort of mesh blockchain with the current financial infrastructure, third parties, and the very intermediaries that the original concept of blockchain from a purely sort of libertarian ideal actually was built to sort of do away with. And I do think that that is a sign of how fast the area has grown, and honestly how well it's done in actually attracting valuations, use cases, and actual commercial applications, right? So so a good sort of quote that I heard, it was that Bitcoin was a great idea, a excellent concept, but in actuality, it never actually panned out. as a medium of doing transactions. As I think Keith pointed out at the beginning of our conversation, Bitcoin, even now, is only a tiny, tiny fraction of the overall monetary base, and the overall percentage of it being used for transactions is under 10-ish% on a international basis. So I do think that, yes, in theory, the whole conversation has changed and the orientation has changed, and so with that comes some risks and some headwinds going forward. But I do think it's a positive sign overall for the continued evolution of space.
Alex, I'd like you to think about a question, which is that one of the things free societies in theory are good at is invention and innovation. I'd be interested in your views. Given, for example, that a CBDC solves the on-chain settlement problem in the securities industry, does it actually encourage innovation or discourage innovation? And while you're thinking about that, I'd like to ask Keith, you mentioned earlier that Bitcoin is a very small part of the total stock of money in the world. We've had a question here which says, aren't CBDCs just a big brother reaction to the liberation afforded by assets like Bitcoin? The latter has just proved itself as a self-governed asset that can weather a liquidity crisis with no intervention from the central bank. And it is true, it is. Bitcoin has had a good lockdown, hasn't it? It's now 200 billion, which is nothing, I suppose, in the context of the trillions of official money, if you like, but it's not trivial either. Are CBDCs an attempt here to strangle an experiment which has quite a long way to run yet, or not? Keith?
I mean, as we said earlier, I think Bitcoin and the growth of crypto assets have, been the antecedents of this whole debate in the first place, and Libra being an accelerator for considering, central banks to consider CBDC as a matter of urgency as opposed to an interesting academic exercise. So I think that's certainly true. But I think the crypto asset world will continue as it does. It's not without its issues. If you look at what's happening on the DeFi world, for instance, it's gone through various perturbations, both in terms of theft and also in terms of lack of operational resilience within the core infrastructure. So whilst it's there's a significant amount of value tied up in crypto asset networks of various types, there's still a certain way to go, I think, to hit the same level of reliability and resilience as we expect in the regular financial systems. And obviously what the central banks are looking to do with CBDC is to extend and build on the questions of resilience, stability, privacy, etc., that you associate with the regular financial markets infrastructure, to be able to bring CBDCs into that environment, to release all the potential benefits that has in terms of implementing monetary policy, in terms of facilitating financial inclusion, whatever it may be in terms of what the central bank's looking to do. And that, I think, will shift the balance somewhat in terms of what happens with the crypto asset world. So it'll be interesting to see what happens with the existing stablecoins that are out there when there's a CBDC available, as we said before, backed by central bank reserves in that respect. So there will be an impact as these two things come together, but I think the crypto asset world will certainly continue to grow and thrive as it does today, albeit with some differences along the lines I just mentioned.
Thank you, Keith. Now, Alex, is a CBDC going to lead to a burst of innovation, or is it going to strangle innovation at birth from where you sit?
Sure. I mean, I've been reflecting on your question there, Dominic. I think it's my view would be it's going to encourage innovation. Any more thinking about changes of, a lot of the discussion we have around CBDCs, as Keith was rightly saying, started off from the crypto world, and that's sort of created the idea of digital currencies being created. But really, it's not so much these days looking at the technology or the or the use of crypto assets at all. It's very much around, we're not looking at peer-to-peer. We are still looking at a centralized networks, effectively, where you're reliant upon a centralized body, a trusted, regulated, centralized body, such as a central bank, to manage a network of participants, and that's a very important function that you can't really remove. But so I don't see it's going to create the sort of concentration that we've had where the in the technology search sector, where Google have come in and dominated it, and they've been able to do that because it's not a geographical, political, individual country monetary control point. It's very much, that's not the issue there, but it is the issue here. Nonetheless, I do think that it's going to, create a lot of innovation. And one of the things that we haven't touched upon today is when you start to introduce CBDC, and if you are able to do these instantaneous payments versus payments, or indeed these instantaneous T+0 immediate settlement, then of course that changes the model. You need a pre-funded model rather than a post-funded model. And so everyone has to have the assets, they have to have them available, they have to have the cash, or they have to have the securities, and that has to be available before they can trade. And so, that in itself creates innovation and ideas around that. So I'm sure that CBDC, is a catalyst for innovation. It may indeed be a catalyst for many firms to, who can't move, particularly some of the clearing banks, who can't move quickly enough to upgrade their old sort of, batch legacy architectures that can't deal with real-time settlement and operate in a batch or quasi-batch way. So I do think it will be a catalyst, but it won't necessarily be. I don't think there's going to be by any means, one Google search engine for CBDC. It's going to be very much each independent country will have its own version of it, and we'll do it for different reasons. I think, as some of our panelists said earlier.
I'm so glad you brought up a practical issue, Alex, about pre-funding. And in fact, we've had a practical question here, which is we talk about speeding things up in payments and trade, but do we need to consider the benefits of slowing things down? For example, real-time payment and settlement requires a significant amount of liquidity to do, and the benefits of netting payments throughout the day or at the end of the day saves banks and other financial institutions a lot in the cost of holding greater liquidity, and allows time for due diligence and AML and KYC checks. So how could a new alternative system mitigate these issues when offering real-time payments? So I'm fascinated by how what would we issue these currencies on? How would they be transferred? And here we have the long-standing question in payments of liquidity. Banks have got these huge liquidity buffers all over the world because they can't always be confident of getting paid on time. You move to real-time settlement, and suddenly maybe your overall buffers are smaller, but actually you've got to find the money. You've got to be good for the money on time. What's the, are we moving too fast rather than too slowly here? I think
that's a great. It's a great observation. Whoever made that one, I think it's certainly you can draw a lot from that from the securities and the derivatives world, for example, where there is actually a desire, for example, if you look at the trading that takes place on most exchanges these days, most of it takes place at the beginning of the morning in a batch cycle, and it's either a batch auction or something that concentrates the liquidity that will get the best price. And similarly, from a liquidity standpoint, you have the CCPs that sit before settlement, which actually, as well as managing the risk, they also form. They're also allowing you to do netting and net 99% typically or more of your trading. So removing the need for liquidity. But as I think some papers point out, if you're a treasurer in a bank and you've got liquidity challenges caused possibly in different currencies, but certainly by virtue of dealing with cash that's coming in and going out from different aspects of your organization's activities, there may be reasons because of timing differences where you want to manage that intraday. And that intraday management, could be facilitated by this sort of, ability to move some liquidity around a lot more easily. And certainly, you see that as well in the securities world, where you've got these collateral utilities, and so Euroclear, for example, has one as well, where it's able to mobilize collateral to the point that it's needed very, very quickly. So I think it's a great question. I think perhaps in a way, it doesn't help certainly liquidity for things to be speeded up, and it doesn't always work in things like price formation.
Yeah, if I can offer a rebuttal on that a little bit. In the banking world, bank liquidity is another way of saying me as the consumer or me as the corporation has a desert, right? Because the bank's holding my money. There's also a lot of global liquidity that's wrapped up in sort of the old style system. So there's about $10 trillion of trapped liquidity in cross-border and interbank transfer globally. And so a number of corporations and banks actually are now engaged in some discussions around creating alternative liquidity pathways that are a lot more responsive and rapid than, kind of end of day netting. So there's some interesting emergence that's coming from new technologies, including central bank digital currency, to free up a lot of that trapped liquidity in the banking system. On the AML KYC side,
I agree with that, by the way. Yeah.
No, absolutely. But I agree with you completely that securities is sort of got a different parallel set of considerations. But on the AML KYC side, I mean, we're stuck with a really antiquated identity system, which incurs on the order of $272 billion a year of cost to the financial system. That's pure friction, the compliance of dealing with the old style AML KYC system. So having better digital identity, which by the way, distributed ledger might be able to help with, could help address this timing issue as well.
David, where did that 272 billion figure come from?
I think it was a McKinsey report, if I'm recalling correctly. It's the global cost of compliance, primarily driven by AML KYC. Compliance right now on AML KYC is more than 20% of the run the bank cost for the average financial institution, and growing 5% a year. It's a spiraling cost.
We're going to invite you back to our digital identity webinar happening soon at a future of finance near you.
Another maybe small interesting point is the majority of what we know about liquidity and netting is all done in this centralized fashion. So that's our context. That's where we come from. That's our safe space. As we move to this potentially more distributed model, more real time, there's a lot of necessary work that needs to be done. I mean, we've looked into liquidity savings mechanisms for RTGS systems. We've looked into netting solutions and how you can implement netting solutions in a distributed context. So there is a lot of opportunity here, and I wouldn't want to assume that if you're implementing a CBDC on a DLT technology, that necessarily means T+0, or that necessarily means that you will never do any netting and the like. It just gives you the option to choose.
Yeah, it's right. Yeah.
Quite a lot central banks can do to liquidity saving already, isn't there, even in the existing system? But Simon, there is a reason that banks exist, which is to oil the wheels of payments, if you like, and they've worked and have been working for many decades now with central banks to make sure that payments happen through the creation of credit. Is that in the project you're working on in the Caribbean? Is that a live issue and problem which you have to address or not?
It's certainly a consideration. I think for those of you who've been to the Caribbean and have had the pleasure of dealing with a Caribbean commercial bank, you'll know that they are farther behind than what we would experience in North America, for example, or Europe. So there are, as I mentioned before, there are a number. It's sort of a serious barrier to entry for a number of people throughout the Caribbean from a financial inclusion perspective. And so looking at the reserve requirements for your lending capacity, that's been one of the considerations certainly for the governor and for the Eastern Caribbean Central Bank. They don't see it as a large threat to start with, and I think the flexibility with which regulators can determine the reserve requirements is also an added benefit. I've also seen, and there was an interesting excerpt from, I think it was either the Digital Dollar Project paper that talks about how you could classify central bank digital currency holdings for clients who are using them like deposits. So let's fast forward to a scenario where, for example, in the US, You have a central bank digital currency that's in circulation, but many clients will remain with their existing financial institution, and those financial institutions will pass along wallets or accounts, central bank digital currency accounts, to their clients. Now, those CBDCs, the aggregated balance of those CBDCs, could count as either part of their reserves, or could be classified as something unique. I mean, the Bank of England has been really progressive in balance sheet considerations for how to deal with these CBDCs. But I think I would just say there is flexibility in determining the reserve requirements for these commercial banks. And there's also the ability to treat the CBDCs that they hold either for themselves or for their clients as contributing to their reserves in some fashion. So again, a combination of policy and technology solutions could comprise the answer, or at least one of the possible answers. But it's certainly something we have to look out for. I think, having tiered, we also have limited accounts in the solution for the ECCB, where you can only hold so much if you're at a certain verification level, for example. The ECB put out a great paper on tiered interest rates based on the amount of holdings that you have. So there's all these sorts of levers that you can turn to discourage bank runs, and frankly to eliminate them. And there's also the ability to monitor that in real time and implement sort of the corresponding monetary policy action that would mitigate the risk of it continuing and being detrimental to the financial system. Again, with all these sorts of policy levers that you can push. And so, this is one of the areas where I'm really excited to be developing solutions for central banks, is figuring out, okay, if we had a network where you could pull this sort of data in real time of central bank money, what's going to be useful? Of course, anonymized, aggregated data, but what's going to be useful for central banks in achieving their mandate? So that's sort of the way that I look at it, and that's how I've seen the literature treating that issue as well so far.
Okay, well, one can see the advantages for central banks, but also the disadvantages for economic and personal liberty, which brings me to a question on that very topic. When I go into a shop and buy a coffee with cash, the barista doesn't know me. I use my card, he or she knows my name and the middleman in the middle of the transaction, the bank, credit, debit card, intermediary, etc. Now they know that I've made a transaction. How do we build CBDCs that don't in some form become social engineering tools of the state? And that's linked to what Simon said in a way which isn't immediately obvious, but you can see on the plus side, if the central bank has complete oversight of every transaction in an economy, and it becomes a major source of credit. It has implications, as we've discussed, for fiscal policy, for the welfare state. So these CBDCs are potentially very powerful tools in the wrong hands. And how do we protect privacy as well as get the benefits of CBDCs? Alex, you lit up. Rob, you nodded. Who wants to go first? Rob?
I mean, I'm happy to jump in and talk a little bit about the technical implementation and some of the challenges around this. I mean, I think it would be helpful to remember that the requirements for buying a cup of coffee, privacy, AML, transaction verification, and the like is going to be very different from that kind of retail story you're telling versus, maybe settling a cross-border security, right? So CBDC isn't one thing. It has to live in the context of a specific use case. And there's a chance that we will see, different CBDC issuances for different purposes with different governing rules around them. So, instead of equating this to, there is just a single dollar and you can use that same dollar for settling a security and you can use it for buying a cup of coffee, we may see different models for different tiers in the system. And, the different attributes of these different CBDC-like instruments will be whether or not this is used to buy a cup of coffee, which is, the retail sector is 90% of the volume, 1% of the value, versus, something like security settlements, which will have very different privacy, transaction, KYC, AML, and the like. So, I mean, back to the cup of coffee example, I think that when we look at some of the implementation in the retail sector, I mean, the guiding strategy is to say, how can we build this so that it looks as much as cash as possible? And if we use that on the retail side, there are technological mechanisms in place to transact in complete privacy, or to transact even when there's potentially no access to Wi-Fi or the like, right? And we introduce more and more of these constraints as we go, I would say, farther down into the retail life cycle, or maybe farther down into emerging economies, and lower down the technology stack. So all of these things exist. It's just a matter of how we construct them in the context of each use case to properly fit the requirements.
Now, I think we must stop soon, although we've lots of people still listening, and we're all fully engaged here, but I'm sure we've all got other things to do. I'd like to just sort of close with one question which we've been asked here, which is this: in the next 5 years, what will be the adoption of CBDCs across the globe? Who do you feel will be the leaders in implementation of innovations related to CBDCs? Crudely speaking, who's going to be first to introduce the CBDC? Who's going to be second? Who's going to be third? Do we know the answer to that, Sean?
I would say that it's awfully tough to state with any sort of authority the first, second, third. I would say that currently, right now, there are quite a few countries that are out there in the running. In Europe, China, obviously. Here in the U.S., we are, I believe, a bit behind, but we are playing catch-up. Caribbean projects are obviously well underway. So I would argue personally that it's not really so important as to who is first to market. It's arguably more important, I think, whose crypto asset is actually going to be used for payments, international transactions, being used, as I think Daniel outlined, for the different use cases, both on the street and in the sort of enterprise space. I would argue that's more important as opposed to who's first to market, because I do believe that especially in such a fast-moving area, being first to market is no guarantee of actually coming out on top.
I mean, the other comment I'd make on that is China, obviously, who were probably first out of the gate. It's already running in pilot at the moment. And I think, when that effort hopefully is successful and then progresses to what the next phase may be and the impact that might have, as I mentioned earlier, on the One Belt, One Road, going back to international trade, etc., I think that gets really interesting and puts the pressure on everybody else in terms of all the other central banks in terms of what approach they should be taking at that point.
What's your prediction there? China first, followed by an anxious United States?
I think the United States is going to be very last.
Yeah.
But for complexity reasons, among others. No, I think what's interesting, so absolutely, Keith, that China's first, that basically you'll see a response to China, and the question is who will be able to respond effectively. Medium-sized domiciles are sort of interesting, where they have vibrant economies, but relatively small numbers of decision makers who can move a project along. So if you look at places like Singapore, they have a very progressive regulator and a lot of money. So they have an opportunity to create a global footprint with a non-aligned currency. And it might be the alternative.
Yeah, no, I agree. And also maybe Switzerland along similar kind of lines as you just mentioned. And obviously that's where the effort from BIS and their innovation grouping is focused at the moment as one of the innovation hubs there. So I think that's also an interesting country to watch.
Absolutely.
What's your prediction? What have you frozen, unfortunately?
Sure. Yeah, so I would say, I don't have a prediction, but what I would say is that it will be a bit of a learning process. So those few who are first out of the gate, particularly if they're in different systems, are going to play a very influential hand in showing other central banks the pros and cons of how they're rolled out. And I think there will be a second phase, a refined phase, to learn about design functions and effects and feedback. We've talked a lot about monetary policy, but we haven't talked about regulation. If the bank funding is going to be impacted, this has an impact on how banks comply with Basel III, and means that central banks have to play a much greater role in providing liquidity for the ECB It already has a framework that does this. It deals with thousands of counterparts. For a central bank like the Fed, where it doesn't have that mechanism, it may need to think about framework redesign or about other ways of providing liquidity for banks. And I think that mechanism over the next 5 years will be an important one.
Well, there's a reason why the ECB ends up funding banks, of course, but we haven't time to go into that now. Simon, I assume your prediction would be the Eastern Caribbean will be the first to market with a CBDC.
Yeah, I guess it's we're on track to launch sort of later this summer. So yeah, I think it will be there. Fully recognize that you know, the size of the state sort of excuse me, separates it, but I think it look, my opinion on the progress here is that it's an opportunity for collaboration, and it's an opportunity to set standards, you know, so that all central banks can be building towards the sort of interoperable future. That's where a large majority of the efficiency gains and the benefits will be realized. And so I think it's important for the standards to actually be taken seriously, to be and for it to be a true collaborative effort for central banks to take into account all the design considerations, policy considerations, et cetera. And we're seeing that already. Groups of central banks who are looking into these things and obviously publishing some great research. But yeah, I hope that we're amongst the first there.
Okay, well, good luck with that. Alex, your prediction, who's first to market?
I think perhaps, you know, some of the suggestions that the other panelists have made around possibly China, possibly Switzerland, but I think I think it will be a journey. I think I anticipate that you know, before getting to proper CBDC, we'll see sort of more of a sort of, you know, reserves-backed digital currency or a synthetic CBDC that's sometimes called, where you know, where the commercial banks will operate something, and they'll be in a limited capacity, and they'll be monitored very carefully to see how that develops and grows. I think perhaps one of the things that I'm less you know, I have a very long time horizon on, unfortunately, and I'm talking about possibly greater than 10 years here, would be where you've got banks, where you've got central banks trying to interoperate. And the reason, I think, is clear from what some of the other panelists have mentioned, which is, you know, there will be different use cases and different types of, you know, they'll all be coming in from a slightly different angle. Not least, and of course, not least, they'll be, you know, there could well be, you know, individual technologies or different technologies or different implementations of the technologies used. So I think that I think it's going to be exploratory first, using you know, and with commercial banks going first.
Daniel, a last word from you, because I think we really must stop at this point. I think CBDC means more than one thing. What's your prediction, your verdict?
No, at this point, it's very, very hard to add anything meaningful. I'll just echo the sentiment that everybody's going to come at this from a different angle. I'll echo the sentiment that it is about who does it right as opposed to who does it first. Dominic, I think you mentioned, you know, the way values are kind of instilled within this medium, and I think that's a very, very important maybe note to take away from this, is that some countries face more of an uphill battle because their values are more nuanced, and their execution needs to be aligned with that. And all I can say is that on our side, we are trying our best to not slow down the progress, the global progress towards this with our clients. So we're very happy to be at the forefront of this as well. Yeah, and thank you for having us.
I'll say one last thing to you, which is that we talked about this for an hour and a half. The audience has stayed with us, and I still feel we've only really scratched the surface of this topic. So I hope that that you, Daniel, and I hope everybody else who's taken part in this on the panel will be happy to come back when we revisit this topic at a future finance event very soon. But as I say, I think it's all we have time for now. I'd like to thank all of our panelists, Sean, Rob, Daniel, Simon, Keith, Alex, and David. And I'd like to thank the audience as well for all your questions, for staying engaged. Do keep those questions coming to us. We're eager to answer them, and we'll pass them on to our panelists if we haven't managed to get to them. So we covered almost all of them today. So thank you. It's been a pleasure to moderate this discussion, and look forward to seeing you all again soon next time we talk about this topic. Bye-bye.
Thank you very much.
Bye-bye.
Thank you, Dominic.
Thank you, Dominic, and thank you to our panel. If you would like to see the summary of this discussion, please visit our website on www.futureoffinance.biz. And indeed, if you would like to see the video again, that is also on our website. Many thanks.